Today I'm going to present to you what this amendment to the code, what it does and what it doesn't do. I think there's a lot of confusion about what it does and what it doesn't do. And then I'll talk about the actual administrating of this provision for the protected and unprotected taxes. And if we have time at the end, then I will open it up for questions. And then if we don't get all your questions asked, then please write them down and I'll address them on Friday. So, this Section 35 of the House Enrolled Act 1072 of 2012, the first things that it does not do, it does not change how the circuit breaker credits and tax bills are calculated. Doesn't affect the calculation of a tax bill. It does not change the treatment of the circuit breaker exempt funds. Those funds that currently are exempt from circuit breaker credits, the debt service and lease rental funds in Lake and St. Joe County, and the referendum funds that are exempt from circuit breaker, they continue to be exempt from circuit breaker. They're going to continue to be treated the same. And also, this does not affect the distribution of the property taxes where there are no circuit breaker credits. So for counties that their tax rates are not meeting that cap limit for circuit breaker, and no one is getting circuit breaker credit, this whole law doesn't affect you at all. It only comes into play when there are actually circuit breaker credits. And the other thing, it does not increase in total a taxing unit circuit breaker revenue loss. This is the one area that there's been, I think, a great deal of confusion, fear, and concern that the funds, there are taxing units who are concerned that the the protected taxes of one unit are going to affect the unprotected taxes of another taxing unit, and that is not going to occur. That will not be the case, and hopefully that'll become more clear when we get towards the end of this presentation. What this amendment does do, it does introduce two new terms, the terms protected taxes and unprotected taxes. The statute says taxes. It's probably better to think of this as protected funds and unprotected funds. This amendment does increase the number of funds that are not to receive reduced property tax distributions due to circuit breaker credit revenue losses. So there are going to be additional funds that are going to be protected with the administration of this change in the statute. This amendment does require that circuit breaker credit revenue losses created by the taxing unit funds that are protected from circuit breaker credit revenue losses be distributed proportionately between the funds of the taxing unit that are not protected from circuit breaker revenue losses. So, emphasize, it's all occurring within a taxing unit. So in the administration of circuit breaker credit, as you all are aware, not all of the property taxes are treated the same. The treatment differs by the type and category of property tax. And currently, here in this year, 2011, pay 2012, there are circuit breaker exempt taxes and circuit breaker non-exempt taxes. So that's what we're dealing with today and for this settlement. And that does not change. That's how it has been. It's how it was in the June settlement, and the treatment will be the same in December settlement. It's not until we get to the settlements next year in 2013 that the protected and unprotected funds administration comes into play. So the amendment itself, it removed the terms exempt taxes and non-exempt taxes and added terms protected taxes and unprotected taxes. So you can see that the code prior to this amendment used the term taxes, but actually in the administration, we were actually administering this at the fund level. And so there were and are exempt funds, circuit breaker exempt funds, and there are circuit breaker non-exempt funds. Now going forward in 2013 and after, we will have protected funds and unprotected funds. The amendment defines debt service obligations as principal and interest payable during a calendar year on bonds and lease rental payments payable during a calendar year on leases that are paid from property taxes or payable from property taxes. Under the category of protected taxes, once again, think of this as protected funds. And putting this presentation together, I kind of went back and forth, discussing this with myself, talking to myself. Do I continue to use the term taxes or should I use the term funds? As you can tell, I stayed with taxes because it does say that in the code, but the practice and administration, this is going to be administered at the fund level. So there are two different types of protected taxes. And one type is what we now call the circuit breaker exempt taxes or circuit breaker exempt funds. That is one of the types that fall under this new term of protected taxes. Those are those referendum funds that are exempt from the circuit breaker credit, and in the case of Lake and in St. Joe County, the debt service lease rental funds. And those funds, those are exempt from the application of the circuit breaker credit, meaning that they are exempt in the calculation of the circuit breaker credit, just like it is now. Whenever your property tax calculation system is looking at calculating the circuit breaker credit and determining whether or not the net rate is exceeding the cap and whether or not there would be a circuit breaker credit amount, deduction amount, those rates for those funds are not included in the total rate used. And that's the way it is now. That's the way it will be next year. That doesn't change. That stays the same. The other type of protected taxes are the property taxes imposed to pay debt service obligations that are not exempt from the application, the calculation of circuit breaker credit. The property taxes in this group, in this category, are subject to and included in the calculation of the circuit breaker credit, regardless of their designation as protected taxes. So when you're calculating the tax bill, these funds are not going to be excluded in that calculation. Those funds are going to stay as part of the total tax rate that is used to make the determination if there is a circuit breaker credit amount. Those are going to stay there. By that, whenever there is a circuit breaker credit amount, when there is a situation where the total tax rate went over the cap level and there was a deduction amount calculated for a taxpayer and a taxpayer was given the deduction, in those cases, those protected taxes contributed to a portion of that circuit breaker credit revenue loss because they were in the calculation. And that's the new part of this. Those funds are going to contribute to there being a circuit breaker credit revenue loss. But when we get to the distribution side, they being the funds, are not to experience a loss in property taxes from that credit that they contributed to or was part of creating. There's the big difference. I wished I could have found something to put on this slide. I kept trying to think of something funny I could put on here. There's nothing funny about this topic, or just something to fill up this side. I battled with this. I created this slide many, many days ago, and I never yet was able to think of what could I put on there. Where could I go out to Yahoo Art or something, find something there. But anyway, the definition, what defines unprotected taxes are all those taxes that aren't protected. So it's all the other funds are the unprotected funds. And this is, you got the IRS coming, is it later today or tomorrow, whenever. I don't know why, like a fool, I decided to continue to do income taxes when I left college many moons ago. And one of the things you have to learn about reading the IRS regulations, they're written by exception. and that's kind of the case with this. So didn't come up with anything, but there's your definition. So as I've already mentioned earlier, those property tax funds that are currently exempt from the calculation of the circuit breaker credit will continue to be exempt. And this whole amendment, this Section 35, it does not change those types of funds. What funds are considered exempt, the type or category of funds that are exempt today will be exempt in 2013. But it does affect that property tax collections are allocated, distributed between the protected taxes and unprotected taxes when there are circuit breaker credit revenue losses. And those property tax collections are be allocated to the funds of the protected taxes as if there is no circuit breaker revenue loss. The circuit breaker revenue loss must only reduce the property tax collections allocated to the funds of the unprotected taxes or the unprotected funds. And the circuit breaker revenue loss must be distributed proportionally between the unprotected funds of the taxing unit. Our current method and worksheet of calculating the circuit breaker adjusted rate for circuit breaker exempt funds for the distribution, that will continue. Those counties who have circuit breaker exempt funds and have circuit breakers currently hopefully know what I mean by this. We do a calculation of an adjusted rate for those exempt funds, and we send that out to you to use for your distribution rate. So you change your tax calculation rate to this adjusted rate for distribution purposes. For those counties that don't have exempt funds or don't have circuit breaker, I'm sure this means nothing to you. You think, what are you talking about? So if you're not getting an adjusted rate from us now for exempt funds, chances are you won't next year. But you may get adjusted rate for the Category 2 protected funds. That's kind of how I think of it. First time I tried to define that the two different categories of protected taxes. I referred to one as Group A and the other one as Group B because one or two, or Category A and B or whatever, but just remember there are two different categories of these protected funds. So next year there is going to be an additional adjusted rate calculation for the protected funds that are not exempt from the calculation, those debt service and lease rental. And just like we do now with the circuit breaker adjusted rate for the exempt funds, there will be a separate calculation for each taxing district for the debt service and lease rental funds. Because the circuit breaker revenue losses as a percentage of the total will differ from taxing district to taxing district, because from taxing district to taxing district, the total tax rate is going to be different, and you know, the dollar amounts of circuit breaker revenue loss are going to increase and decrease accordingly. And this is going to come mostly in play with schools. And if you're not already aware of the fact, this is a hot topic for schools. Schools are not exactly elated about this change. I'm sure some of you have already had discussions with schools. I've had some discussions with schools. And so it's just a very, very popular topic with schools right now. Just like we do with the adjusted rate for the exempt funds, we're going to use the abstract data to calculate the adjusted rate for the debt service and lease rental adjusted. The one main difference, here's where the big difference comes into play, between our calculations for the circuit breaker exempt funds and the calculations for these debt service and lease rental adjusted rate calculations, is that only the taxing units abstract data within the taxing district will be used in the calculation of the adjusted rate, and we will not be using the total taxing district data as we do with the circuit breaker exempt adjusted. After your abstract is approved and before the 2012-2013 property tax distributions are calculated, we will be sending out to you these adjusted rates for you to use. I caution you, you want to make sure that you wait, or at least ask us if this is going to affect you before you calculate any advances in 2013, because you need these adjusted rates. If this is going to be applicable to you, you're going to need these adjusted rates to use for your advance calculations. And so please. That second bullet point, where that's this big difference coming into play. When we go through the process of calculating these adjusted rates, prior to the adjusted rate calculation, a taxing unit is going to receive, or their rates make up a certain percentage of the taxing district total rate. And by that, they then get a certain percentage of the tax collections out of that district because of that, because you use the rates to allocate. So if the school is currently in taxing district A getting 15% of the total before we do any rate adjusting or calculating, they are going to get 15% after we do the rate calculations, because whatever we decrease a protected or unprotected fund rate by, we will increase the protected funds rate. And so in sum, the rates will all sum to the same total. It's just that we're going to move it between the funds, and therefore then when you use those changed rates, you will be distributing more dollars to the protected fund out of that district and less to the unprotected funds. And there's where we come into where the schools don't like this. But there's not a whole lot or anything that we can do about it right now. I mean, this is the way the law is, and this has been the interpretation. We had a meeting with the fiscal staff from both caucuses and both chambers, plus we had DLGF, Board of Accounts, our office there, and we went through this and decided what does this mean and what does this not mean. And that's one of the things we decided, that for one thing, we can only do these adjustments within a taxing district. And if the schools in taxing district A, B, C, and G, we will be doing a different calculation in A, B, C, and G. And their rates in A could be different than the rates in B and C and G. There just wasn't a good way to go across the unit as a whole, across districts, because we get back to this point of the circuit breaker is different by terms of percentage in each district, or could very well be, and most easily is. You know, the circuit breaker revenue loss in taxing district A may be 10%, but it's 20% in B, and it's nothing in C, and it may be 15 in G. So in C, there won't be adjusted rates because there is no circuit breaker loss to protect the fund from. But in A and B and G, there is going to be a calculated rate, and it's going to probably be different in A, B, and G. The other, I know there was another thought I had there, excuse me for a moment, to tell you about. They'll probably come back to you. Another question that has been raised is TIF. Is TIF affected by this? And the answer is no. Because TIF isn't a fund, TIF isn't a rate, TIF is an intercept off the top of collections to go to the Redevelopment Commission. So that is the reason that it's not. Another question that was raised, and actually Courtney brought up before it was even raised as a question, and we had some discussion and exchange of emails on, is what about those instances where a unit has within a non-protected fund, i.e. general fund, payments for debt service and lease rental in that fund? What are we going to do in that case? The position taken is that that isn't included in this protection, from the standpoint that that is an appropriation within that unprotected fund and isn't a specific levy or a specific rate. So therefore, it's not going to be included in this.